we are covering these 8 top actively traded stocks that are bullish today. Nike Incorporated, the global giant behind those swoosh-branded sneakers, iconic Jordan drops, and everything from fitness apparel to performance gear, is once again right in the middle of a geopolitical headline that's shaking up its stock. This is a company that relies heavily on international manufacturing, with about 25% of its goods coming out of Vietnam. So when tariffs get tossed around, you can bet Wall Street is watching. Today, Nike shares were up 3%. But what makes that move stand out is the context. The broader market was in full-blown sell-off mode. The S&P 500 dropped 6%, the Nasdaq sank nearly 6%, and the Dow wasn't spared either. So when a mega-cap retail name like Nike finishes in the green with a solid 67 million shares traded, it's not just background noise, it's a statement. Now let's unpack what really moved the needle here. Earlier this week, Trump announced a steep 46% tariff on goods imported from Vietnam, which sent shockwaves through the entire retail space. Stocks with heavy exposure to Vietnam, and that includes Nike, took a hit. But then came the twist. On social media, Trump said he had a very productive phone call with Vietnam's General Secretary, To Lam. The big headline: Vietnam is reportedly open to negotiating tariff cuts, even floating the idea of reducing them to zero if a deal can be reached with the U.S. That's a major shift, and it matters. Nike has strategically shifted a big chunk of its manufacturing out of China and into Vietnam over the last several years to avoid previous tariffs. But this new wave of tariffs threatened to undo all of that. If Nike suddenly had to pay 46% more to bring in shoes and apparel from Vietnam, those costs would have to get passed on somehow, either through tighter margins or higher retail prices. Neither of those outcomes is great for a brand that prides itself on scale and price competitiveness. So what we're seeing now is a bounce, a little relief rally, on hopes that this tariff situation could de-escalate before it really bites. It's also worth noting that Stifel reiterated a hold on the stock with a $75 price target. So while analysts aren't jumping to call it a screaming buy, they're acknowledging that Nike might have some room to run if these trade tensions ease up. Looking forward, this Vietnam deal, or lack thereof, could play a huge role in Nike's near-term valuation. If the two countries work things out, Nike could dodge a major bullet and keep its cost structure intact. But if negotiations stall or break down, the company could be staring down some serious headwinds, right as consumers are already growing price-sensitive. So yeah, today's 3% move is more than just a blip. It's investors starting to price in the possibility that Nike could avoid a worst-case scenario. Keep an eye on how this trade story develops, because for Nike, this is way more than a political headline. It's directly tied to its bottom line. Opendoor Technologies Incorporated, the digital-first real estate platform that's trying to simplify the way people buy and sell homes, had a pretty interesting day in the market. Shares closed up about 2.4%, and what makes that pop a little more notable is the volume. Over 64 million shares traded hands. That's a lot of eyeballs on this name today. So what's going on? Well, while this isn't some massive breakout move, it feels like there's a bit of quiet optimism building around Opendoor right now. We're talking about a company that lives and breathes real estate, specifically digitizing the traditionally clunky home selling process. With their sell to Opendoor and marketplace offerings, they're trying to take out the middleman, the hassle, and the time lag. It's all about convenience, speed, and taking friction out of what's usually one of life's most stressful transactions. Now, real estate's been in a weird spot lately. Rising rates slowed everything down, but there's a bit of a shift happening. Investors may be sniffing out a setup where Opendoor could benefit from a more stable or even slightly loosening housing environment. And if demand starts to return, platforms like Opendoor could gain traction again, especially with consumers who want simplicity and control. Also, that high-volume hints at some institutional movement or speculative interest, possibly positioning ahead of earnings or a macro catalyst. And with Opendoor's capital-light marketplace model getting more attention lately, there's a growing narrative that it could scale better than people originally gave it credit. safer, especially if they're not tying up their balance sheet by owning as much inventory. So yeah, a 2.4% move might not look huge on the surface, but in the context of 64 million shares traded, it feels more like a pulse check, like the market saying, "We're watching you." It'll be interesting to see if this interest holds up or if something bigger is building beneath the surface. RKT Companies Incorporated is a financial technology company that blends tech with mortgages, real estate, and personal finance through well-known brands like Rocket Mortgage, Rocket Homes, Rocket Money, and more. Today, the stock popped another 11% with 36 million shares traded. And that move is riding a wave of momentum from a big quarter that's seen shares climb 40%. A lot of this rally is tied to a combo of aggressive growth moves and a renewed focus on delivering value to shareholders. Rocket recently announced a special dividend of 80 cents per share, a rare move in the fintech space, and revealed plans to acquire Mr. Cooper Group and Redfin. That's a huge play to consolidate the home buying process under one roof, from finding a property to financing and closing the deal. It's a signal that Rocket isn't just playing defense in this market. They're going on offense. This all comes after a strong financial rebound in Q4 2024, with revenue coming in at $1.77 billion and a turnaround to profitability. And leadership changes have added to investor confidence. CEO Varun Krishna, who took the reins in late 2023, has been pushing the company towards smarter tech, tighter execution, and stronger returns. There's also been a big push on the AI front with a new CTO, and the launch of the Rocket Visa signature card in 2023 shows they're thinking beyond just mortgages. So while broader markets have been getting knocked around by tariff headlines, Rocket is standing out as a bright spot, showing resilience and some serious strategic focus. Investors seem to be betting that this isn't just a short-term bounce, but a company that's positioning itself for long-term relevance in both fintech and real estate. Kohl's Corporation, the well-known omnichannel retailer with over 1,100 stores and a robust e-commerce platform, saw its stock jump nearly 8% today on some surprisingly bullish sentiment. And what's really interesting is that this move came alongside a notable shift in short interest. So here's what's going on. Kohl's has been one of those names that's had a big target on its back from short sellers. In the last update, more than 61% of its float was sold short, which is massive, one of the highest short interest levels you'll see on a major retailer. But now, new data shows short interest has dropped by nearly 10%. That's a pretty meaningful shift. It suggests that some bears are starting to throw in the towel, maybe locking in gains or stepping back from what's become a very crowded trade. Now, when you pair that short squeeze potential with 25 million shares trading hands today, which is way above average volume, you get a recipe for a sharp move like the one we saw. It doesn't mean Kohl's is suddenly out of the woods fundamentally, but it does show that sentiment is shifting, at least in the short term. Investors are likely sniffing around for signs of a turnaround or hoping for some kind of catalyst, whether it's improved margins, a stronger performance from their Sephora partnership, or even a potential activist shakeup down the road. And given the heavy short interest, all it takes is a little spark to get the stock moving. Bottom line, today's move feels like the market recalibrating its view on Kohl's. The fundamentals haven't radically changed overnight, but when shorts start to ease off and volume spikes, it's a signal that something's stirring under the surface. Worth keeping an eye on, especially if momentum keeps building. MicroStrategy Incorporated, better known these days as a Bitcoin treasury company, is one of the more fascinating crossover stories in tech and finance. While they still have a foot in enterprise analytics software, think AI-powered tools and MicroStrategy One, let's be honest, most eyes are glued to their Bitcoin strategy. They've gone all in, using equity and debt to load up on BTC and position themselves as a kind of proxy for institutional crypto exposure. Now, despite all the turbulence in the broader market, especially with China rolling out retaliatory tariffs that knocked crypto stocks, MicroStrategy was actually up 4% today, with 24 million shares changing hands. That's a solid move, especially when the Nasdaq's been getting roughed up. And when you zoom out, the stock's up about 3% over the past month, which says a lot about how it's holding up in a shaky environment. One of the more interesting nuggets here is the company adding Mizuho Securities and Cantor Fitzgerald to its latest bond offering. That may sound like a minor switch, but it's the kind of thing that signals institutional appetite is still there, or at least growing, for what MicroStrategy is doing with its debt-to-Bitcoin model. It's basically saying, look, we've still got credibility in these circles and more players want in. That credibility's been building. Don't forget they were added to the NASDAQ 100 back in December, and they closed at $2 billion follow-on equity raised not long before that. Pair that with January's launch of MicroStrategy ONE, their beefed-up AI analytics platform, and it's clear the company is trying to keep its original software DNA alive, even if the spotlight is mostly on their Bitcoin holdings. But let's be real, this is a high-risk, high-reward play. The company's still and profitable, it's taking on debt, and there's dilution happening along the way. Still, with Bitcoin climbing over the past year and institutional interest creeping back in, MicroStrategy is making a bold case that they're not just surviving this volatility, they're leaning into it. For investors, it's definitely not one to sleep on. Gap Incorporated is one of America's go-to specialty apparel retailers, with brands like Old Navy, Gap, Banana Republic, and Athleta covering everything from basics to lifestyle fashion. It's got a strong omni-channel game too, stores, online, mobile, all synced up to meet shoppers wherever they are. And even though the retail world can be tough, Gap's keeping up with the competition by leaning into tech and convenience to make the shopping experience smooth for everyone. Today, shares jumped over 7%, with 22 million traded, after a major rebound in the retail sector. Just yesterday, the stock took a hit alongside other names on news of steep tariffs on Southeast Asian imports. And that's a big deal for Gap since much of its manufacturing happens in countries like Vietnam and Cambodia. But after a call between President Trump and leaders from both countries, there's now talk of possibly cutting those tariffs, even down to zero. That kind of diplomatic optimism immediately calmed markets and helped retailers bounce hard. In fact, Gap wasn't the only name to see a lift, with other brands like Nike and Lululemon also recovering strong ground. Beyond the tariff headlines, Gap's financials have been showing real progress. They've got $1.1 billion in net cash, more cash than debt, and their free cash flow has been outpacing EBIT, always a good sign. Their EBIT also grew 85% in the last year, showing signs that the business is gaining traction again. All this positions Gap better than some of its peers in the retail space, who might still be struggling with higher debt levels or slower growth. With a solid cash cushion and a focus on improving margins, Gap looks more resilient than it has in recent quarters. So yeah, it's still retail, there are always risks. But between the strong cash position, improving earnings, and cooling trade tensions, Gap's starting to look like it's finding its stride again. They're not out of the woods yet, but they seem to be on a more solid footing moving forward. With a little bit of luck on the tariff front, this could be a solid rebound for Gap. GameStop Corporation has been a major player in the gaming and entertainment retail scene, offering a mix of video games, tech, and collectibles through its stores and e-commerce platforms across the US, Canada, Australia, and Europe. With over 3,200 stores under various brands like GameStop, EB Games, and Zing Pop Culture, it has established itself as a go-to for gaming enthusiasts and pop culture fans alike. Recently, GameStop stock saw a notable 11% jump, with 20 million shares traded, following some interesting developments. First up, there's the delay in Nintendo Switch 2 pre-orders, originally set to start on April 9th, 2025, which has stirred up some chatter. GameStop confirmed that while pre-orders won't be happening just yet, the company is still working closely with Nintendo to keep customers in the loop. Despite the delay, the launch date for the Switch 2 on June 5th remains unchanged. For GameStop, this is a bit of a mixed bag. While a delay might not be ideal for short-term sales, the strong relationship with Nintendo and the upcoming console's launch is still a big win for future foot traffic and sales when it hits the shelves. Adding some drama to the stock, insider trading activity has also caught attention. Mark Heyman Robinson, GameStop secretary, sold nearly 4,700 shares worth over $105,000, while Daniel William Moore, a PFO and PAO, sold 1,600 shares for about $36,000. While insider sales are a regular occurrence, they can sometimes make investors uneasy, raising questions about whether insiders see something on the horizon that the market doesn't. So, while the overall mood today seems positive with the 11% increase in GameStop stock, it's a good reminder to keep an eye on these developments. There's potential in the Nintendo Switch 2 launch, but with shifting insider actions and broader market concerns, including potential impacts from tariffs on the gaming industry, there are still some factors to watch closely. But for now, it's a solid day for GameStop and its investors. On Holding AG, based out of Switzerland, has really made a name for itself in the world of athletic footwear and apparel. Known for its cloud-like shoes and performance-focused gear, the company's been on a steady climb, carving out a solid spot in the competitive athletic space. Their direct-to-consumer approach, both online and through their own stores, has helped them connect with a global audience, making waves across the athletic wear market. Now, we're seeing on Navigate what analysts are calling a normalization phase after years of fast-paced growth. Analyst Randall Connick, who recently initiated coverage on the stock, has given it a hold rating with a price target of $44. It's a bit of a mixed bag here. ON's growth has been impressive, no doubt, but we're seeing that pace slow down. The company, while still maintaining a solid position in the market, is starting to feel the pressure from heavyweights like Nike, who are always on the hunt to maintain dominance. Even though On Holding has a strong balance sheet and solid cash flow, meaning they're in a good spot financially, the stock's been pegged as fairly priced at the moment. This suggests there's not a ton of upside in the near term, at least not until there's a significant shift in either consumer trends or ON strategy to outpace its competition. Despite all that, the stock still saw a 5.21% bump today, with 20 million shares traded. This increase could be a sign that investors are still feeling positive about ON's future, maybe betting on their ability to adjust and innovate in a more competitive market. But given the analysts' caution and the broader market context, it's clear that while On Holding is a strong player, the next phase of growth might be a bit slower and more challenging. If you're holding or thinking about jumping in, it's worth keeping an eye on how they manage that balance between maintaining market share and fending off rising competition. Please subscribe, give the video a like, and watch more from our playlist. Thanks.